Happy Thanksgiving, investor friends. I'm Michelle Markey, and the first thing I'd like to say on this day of gratitude is thank you so much for watching my YouTube channel. And on this investing journey, I try to equip myself with as much knowledge as possible about the economy, the investing climate, and any other kinds of trends and signals that help me to make informed decisions about my finances and investments. And with the coronavirus recession we're in right now, as of November 2020, which we've officially been in since June of 2020, with the National Bureau for Economic Research saying that we've had enough of a downturn in the economy to indicate that we're considered in a recession. And officially, a recession would typically be defined as a decline in gross domestic product or GDP for 2 quarters in a row, but the National Bureau might decide that we're in a recession sooner based on several economic factors. So although we're still not in a great place in terms of our American economy, you might not realize that we're still in kind of a bad shape for the greater good of the American people if you just looked at the stock market, which has been hitting all-time highs recently. For example, the S&P 500 hit 35 to 3,600 recently. The Russell 2000, a marker of small cap businesses, has hit 1,800. The first time it's been back up in that range above 1,740 since August of 2018. And also the Dow Jones was just shy of 30,000. So if you just look at the stock market, you would think everything's fine, but unfortunately, we're not quite out of the woods yet. While coronavirus cases surging all over this country and all over the globe paints a somber picture of uncertainty, the most important thing is to have our health and be safe. And then secondly, worry about money after that. But as much as we can help it, it would be good to not lose money during these dark times. And I'd like to share a message of hope from what I've learned and observed, and also some of my opinion. So what I'm aiming to do today is educate you on trends and signals that I use. And I want to also say that nobody knows what will happen in the future. There's no reliable way to predict what's going to happen in the American economy or in the stock market. So although I follow some of these signals, you can't always be sure as to what's really going to happen. So you just try to do the best you can to prepare yourself and to be ready for when there's an opportunity to invest and to also save more money in spite of some current trends that might not be as advantageous to your bottom line. But again, I want to share that there is hope to be had, and that as long as we are healthy, that's one of the most important things we could possibly have, and which I'm most grateful for. So with that being said, I'm going to provide a high-level overview of some of the macroeconomic state of affairs we're in that can be just as complex as putting together Thanksgiving dinner. And just to give some perspective, in the Great Recession around 2008-2009, lawmakers in the US authorized about $1.5 trillion as stimulus to help bring the economy back to where it was and to recover and stimulate, while we've already, as far as I know, we've hit at least $3 trillion so far in the coronavirus recession, and that's basically double what it was in the Great Recession. And that's just fiscal stimulus, or what's authorized by the US Congress as to what they can do to help get the economy to spend money, which makes up something like 70% of our economy is consumer spending. And while that's important to note, a lot of Americans are relying on the stimulus and expecting more to come, as some of the current CARES Act stimulus is about to expire at the end of the year. So going into 2021, that's going to be something to look out for if there will be more fiscal stimulus. But what I'm also going to talk more in depth about includes monetary stimulus. And overall, I'd like to bring our attention to an agenda I put together asking a central question: where are the American economy and markets going at the end of 2020 and into 2021? and also considering where we think we are, which is what I like to call an everything bubble. So if you turn your attention to this somewhat busy slide here, I review how we've been at unemployment hitting 14.7% in April 2020, and that went down by 7.8% to 6.9% as of October, according to the Bureau of Labor Statistics. And about half of the 22 million US jobs that we'd lost have been recovered, which is sort of helpful, but maybe not the most reassuring, as well as high-level topics in how the Wall Street Journal reports that student loan defaults are at a rate that's getting close to what subprime mortgage losses were, and as well as how one writer at the Wall Street Journal thinks that markets are on fire rather than being more like a bubble. And we're in a state of what I think is pandemic irrational exuberance, and I was trying to see if Robert Shiller, who won a Nobel Prize for his work in economics, if he had much to say on this topic, although I couldn't find that much. He did make a little bit of comment on this earlier this year, and how we're in a late cycle in the stock market. That's based on an article I read by Jesse Felder. And also I'll go more into depth of what the Wilshire GDP is about and the idea of what the Fed is doing in money printing by Phil Town, and some of the thoughts that I've learned from Phil Town, as well as how Ray Dalio, a renowned billionaire hedge fund investor, believes that we're at the end of a short and long-term debt cycle, as well as what an Atlantic article has discussed in the risks associated with collateralized loan obligations, and what Phil Town thinks we can do to have some hedges against the inflation that results from money printing. And these include commodities and assets, and also a touch on why Ray Dalio thinks that cryptocurrencies could get outlawed, so they're not as much of a hedge against inflation if you're trying to live in a country governed by a certain currency, and in that country, if crypto is outlawed, you can't really use it anymore. And then also well-known investor Michael Burry, who accurately predicted the catastrophe that was going to happen with the mortgage security-backed issues in the Great Recession, how he now thinks we're in an index fund bubble. So among all these topics, I know they might seem like a bunch of random ideas, but each of these ideas gives a signal towards where I kind of think we're going, but how I also want to prepare towards all of these things. With a US unemployment rate still about 3% above where we were before the pandemic, and people struggling with food, rent, and student loans, it kind of feels like we're on this K-shaped trajectory. And I am careful to say I don't think it's a recovery. Some people use letters of the alphabet to describe somewhat of recoveries, and you could have things like a V-shaped pattern where markets or the economy goes in a straight down but straight back up pattern, or a U economy where we go really down and then have a long way of coming back up again. And then there's also something that's considered a K-shape, where people who have it rough, like people who don't have jobs or enough savings, or on the front lines working in retail or working in places where their health is in danger, they might be on the bottom leg of a K. Whereas like people who have white collar jobs, or they have enough savings and can stay at home safely all the time, they might be on the K-shaped recovery, where if you have assets in this economy and you're able to stay safe that way, you're able to be on an uptrend, while a lot of people still are not on an uptrend. So I just want to be careful to say that I don't think we're in that much of a recovery, in spite of some things like some of the unemployment claims have been going a little bit down, but then they started going a little bit up again with the surge in coronavirus, as well as there's some economic factors that show that it's still not as if the American people have fully recovered the jobs, as well as a lot of people are still expecting stimulus to just get by. So with some of those ideas in play, it's still a little bit early to call kind of where we are in terms of, are we recovering in the economy, or are we still headed for more pain? We might let ourselves think, if we have 401ks, that everything is fine because markets have been hitting all-time highs lately and everything looks like they're on the up and up. But this could be a red herring for what's really to come. And although markets seem to have been somewhat exuberant lately, to somewhat of an irrational degree in my opinion, there's reason that they're doing that. It's because with Moderna and Pfizer coming out with seemingly successful trials of a coronavirus vaccine, it's no wonder that markets have been rallying on this kind of positive news, which is great and hopeful to show us that hopefully in 2021 and going forward, we'll be able to finally get over this terrible illness and hopefully reduce the amount of people who get affected by it in the future. But until that point in time, it's also scary to see that markets are not reflecting reality of so many people who are struggling. And I also want to say that we need to pay attention to some signals like a Shiller PE, which is also known as the cyclically adjusted price to earnings ratio, which is adjusted for inflation and takes the average of the last 10 years earnings. And on average, both if you were calculating with Shiller's PE or just the normal way that price to earnings is calculated, it's hovered around 15 for the last several years and into the 20th century. But right now, we're definitely in the 30 range. So if Shiller P is showing we're at about 32, the normal way to calculate shows that we're about at 35. And the only times that we've been at this place of above 25 PE has been in times like 1929, 1999, and 2007. And everything that followed thereafter was not a good time, as history will tell. And so it begs the question, will history repeat itself when it comes to looking at this kind of signal? And if there's any correlation to, could the markets go down again? Although we did see a big drop this spring. So although we saw say for example, the S&P 500 and other indices go down by about 35%, was that really enough to say that we're now on the leg of recovery? I'm not so sure. In listening to financial podcasts, I came across Jesse Felder and thought that he had helpful things to say and educate investors about. And in one of his recent articles, he talks about how we're in a late cycle of the stock market, in which the stock market has never been more expensive than it is today. And he reviews fundamentals and sentiment and technical indicators to suggest that the stock market is really overvalued right now and that there's more likelihood of downside risk than there is for that much more upside to the stock market. And some of what he mentions in fundamentals means looking at things like earnings, cash flows, net asset values of companies and the overall stock market. And I'll get more into this one indicator in fundamentals in a little bit. But to quickly touch on sentiment and technicals, sentiment is just how investors are feeling towards a market, and technicals are using tools to analyze price trends. So using things like graphs and tools that your brokerage firm provides so that you can analyze where a company or the market is going. Both Jesse Felder and Phil Town recently have brought up Warren Buffett's yardstick, which Buffett considers to be the single best measure of valuations, and it's the total market value of publicly traded securities and as a percentage of the country's business, or also known as gross domestic product, GDP. And that's a quote from Warren Buffett in 2001, where he discusses the Wilshire 5000 total market cap index, and it's over gross domestic product. So for example, some of the numbers that you can use to kind of guess at the framework of how the St. Louis Federal Reserve Bank, also known as Fred, arrived at is by guessing something like, let's say our GDP is at $19 trillion and the total market cap is at $38 trillion. So that puts us at around 200%, which is, you can see a little angry emoji face here because it's never been more expensive based on this fundamentals kind of indicator, where Warren Buffett has said something like it's a good time to buy companies when they're below 80%, or something like between 60 to 80% in this ratio. It's a good time to buy companies. But when they're probably between 80 to 100 or even up to 120%, maybe that's when they're around fairly valued. But as soon as you start getting above 100 to 120%, things start getting to be a little bit more expensive to buy, and likely show some danger in that the stock market could go down. But as we've seen from a lot of stimulus that went into the economy following the Great Recession in 2007 through 2009, we've been on an incredible uptrend that puts us at twice the amount of GDP right now with the total market cap. It's incredible how this kind of evaluation of where we are in the stock market is at a level that we've never been at, and that kind of scares me and makes me not want to invest too much in this overvalued market. When it comes to monetary policy, or what the US Federal Reserve, our central bank, is up to in terms of what it can do to try to help get the economy going, I pay attention to where interest rates are and where inflation is going. And interest rates right now from the Federal Reserve are at about 0 to 0.25%, which is basically nothing. The Federal Reserve is keeping its federal funds rate, which is what it lends to other banks or across the world. It allows it to stay at such a low rate because of where our current economy is and its struggles to get businesses back, and also where inflation is going. So the Fed likes to target a 2% core inflation rate, and as of August that was at about 1.6%, and it's based on a personal consumption expenditure price index. I know that's a mouthful, and it used to be based on consumer price index, but that was a while ago. So now it's this other kind of measure, and some other websites tend to argue that maybe that official measure of inflation is not the most accurate, and there's alternative suggestions that we could be at a much higher inflation rate than the Fed promotes. But for now, we're going with that inflation rate. But with a lot of the money printing that the Fed has been doing, which Phil mentioned, that serves to actually increase a lot of inflation, which can be helpful if you have a lot of debt and you're trying to pay that off with a devalued US dollar. So with a cheaper dollar, it helps to reduce the value of our debt, and the US government can pay back our debt that we're generating by quote unquote printing money, which is just giving money to our lawmakers so that they can spend it, and then it can help stimulate the economy again during crisis times like now. But with our increasing debt, it's also causing some instability in our economy. So that, as a sign for where things are going, is not great, because it would be hard to argue that interest rates will stay down here. At some point, like my cousin has mentioned, there could be some warning in bond markets where governments across the world and people who buy bonds won't want to always accept low interest rates for bonds. And there could be some crisis going on in the bond market someday where at some point people will demand a higher interest rate. But if we have raging inflation, at some point it's not going to be okay for people to keep accepting such low interest rates in the bond market. So that's also something to pay attention to see if there's any risks associated between the bond markets and where inflation and interest rates are going. Both my cousin John and I study Ray Dalio's teachings, and there's so much to say about Dalio, but I'll just touch briefly on how we think we're at the end of a short and long-term debt cycle, as Dalio has been publishing a lot on recently. And with a short-term debt cycle, that reflects the short-term booms and recessions that last about 8 to 10 years in between. So the last time we had a recession about 11 years ago, this is the current short-term cycle we're in, and it's probably bound to end sooner than later, I would guess. And then a longer-term debt cycle is when there's a new money and there's new credit, which happens around 50 to 75 years worth of time. So the last time we started a new long-term debt cycle was in 1945 at the end of World War II, and it was when a new monetary system, the Bretton Woods system, was established. So being that Dalio thinks that we're coming to an end based on a lot of research he's put out there that's available for the public to check out, I think it's pretty compelling to worry a little bit about some of the debt that we've had at incredible levels. And a lot of that debt is leveraged, according to a lot of different people who've researched this, including Jesse Felder, who, based on some sentiment, has indicated that margin debt is a measure to show that we're at incredible debt levels, as well as how our debt of around $25 trillion is at 107% of GDP. So being that we have incredible debt in the United States right now, that's not a great sign for what's to come. And at the end of the day, someone's going to need to pay the bill for that, unless the can just keeps getting kicked down the road. So there's one of two ways that this will go, per my cousin John also talking about this with me lately. And we could have a deflationary debt deleveraging, which could be kind of like the Great Depression or what Greece went through in its austerity debt repayment situation. Or we could have an inflationary debt deleveraging where we keep just increasing inflation until we get to a point of hyperinflation, and that would be bad, like if we got to a Venezuelan or Argentinian situation with our money devalued. That's the more likely path we're going to take, of devaluing our currency on the path that it has been going on, and Phil Town has also mentioned that. So it's definitely a cause for concern that we could be headed in this direction of hyperinflation, but it's helpful to pay attention to these kinds of things so we know at a macroeconomic level where the trends are headed and how we should brace ourselves for this. Many articles talk about our staggering levels of national debt as well as corporate debt that are reaching really high levels again. And one of the instruments that banks use to try to derive some investment yield are things like collateralized loan obligations, which is like a new version of collateralized debt obligations, or CDOs, from the Great Recession times that fell out of favor because they leveraged subprime mortgage-backed securities, and as Michael Burry predicted, we're going to end up in a bad place. So similarly, these CLOs are also loans made to troubled businesses that can't just go to sell bonds to the market, but now have to get these CLOs for some liquidity. And these also pose a risk as of July 2020, when the Atlantic framed this concern. So I'd be worried about something like the resurgence of corporate debt being unstable. And I also want to say that with Michael Burry pointing out that there's an index fund bubble, that's a reflection of how there's been a lot of massive capital inflows into the stock market, and it's not a price of the index that reflects actual fundamental security analysis, but it's just based on a lot of people putting the money into the market, and some of it is pension funds that have nowhere else to put the money but to invest in index funds, and that's also a bit of a concern. Like I mentioned in one of my other videos, if we have a crash, it could be like sheep falling off a cliff when there's massive selling in the market. So I worry about that, probably like how Michael Burry does. All this talk of gloom and doom in the markets and the economy could leave you feeling paralyzed, like not knowing what you should do. But some of the things that I would suggest, based on what I also learned from Phil Town, is with the money printing that the Fed is doing and inflation going up, we should invest in things that are assets that can hedge against this inflation and likely will go up. So right now, it's no wonder the stock market is also going up, because it fully knows that there's a lot of money being printed right now, and that's figurative. Money is not literally being printed, by the way. But with the devaluation of the US dollar, something that keeps up with inflation is the US stock market. So it makes sense that it's actually going up right now. But other kinds of things that will go up with inflation include actual hard assets such as real estate or gold and silver and other commodities like uranium. And some people might argue that maybe cryptocurrencies could be used as a hedge, but as I briefly mentioned earlier with Ray Dalio, I wouldn't trust that cryptocurrency could be such a useful hedge. And then, so if you want to protect yourself against increasing inflation and a market that's going up, and you want to hedge against some of the risks that there could be in the stock market, you might want to own some physical gold, or also maybe invest in things like gold mines or other companies that mine other kinds of commodities. And maybe there will come a time when the stock market is not just continuing on such an uptrend, but others will realize that there are other interesting things to invest in, that in the event of a downturn, there are other assets that will at least maintain their value. Not that you expect that they necessarily will increase in value with inflation, but that they are just holding their value. So if you're worried about protecting the value of your money, you would try to park it for now in some of these inflation hedges while the dollar's getting devalued from the money printing. And although that's not super comforting to know that the purchasing power of a US dollar is going down right now, and it technically will buy less than it did yesterday for the time being, at the same time, Warren Buffett warns that be fearful when others are greedy, and be greedy when others are fearful. So markets are at all-time highs right now. Like, I look forward to when it might go down again someday so I can buy companies at a margin of safety valuation price, and then I can invest and run out with a bucket, not just a thimble of money, so that I can invest when it really matters, and in that sense contribute back to a real economic recovery. So until we get to that point in time, it's hard to say. So it kind of feels like we're sort of stuck in between a rock and a hard place. But that's the main message of hope I want to give, is in addition to hopefully getting a coronavirus vaccine rolled out in 2021, that hopefully we'll have good opportunities to invest in the companies that we can believe in, and that hopefully won't go bankrupt during this hard time, but that will still stay resilient and anti-fragile, like Nassim Nicholas Taleb says in some of his books. And by investing in anti-fragile companies, or also companies on sale during a market downturn, we can hopefully enjoy some financial freedom in the future, like Warren Buffett and Charlie Munger do. So if you enjoyed this video or learned something, please like and subscribe. And if you have questions, please leave them in the comments and I'll do my best to answer. So again, please stay safe and healthy during these tough times. And till next time.